Hello, good morning. My name is Joe Cordell. This is another episode of Cash Counsel. We've been talking about issues related to estate planning. And now let's pull back a step and talk about why we do this show and how our topics relate. What's the common denominator? The common denominator of what we discuss here on Cash Counsel are things that relate to asset protection, particularly for those who have a significant amount of assets, executives who have high incomes, and as a result, the assets that accompany those. Many people who view this show have small businesses. Some, like Joe the plumber, for those of you who've been watching the news lately, who expect to own a small business soon. So we want to talk about taxes, ways to assure that your assets are handled correctly in the way that you would like to have them handled at a time when you can no longer control that. So maybe it's a little less sexy side of the asset protection discussion, but yet it's the foundation in many ways. So as I've said before, and it bears repeating, to the extent that you're thinking about protecting your assets, maximizing the value of your estate, so to speak, during your life and thereafter, you've got to think about some of these strategies that fall under that very much unappreciated title of estate planning. Okay, so I want you to focus on these topics and then think about how you can utilize them in a tangible way during your lifetime to create more income for yourself, more net worth, more flexibility perhaps with respect to your plans in the future, whether it's a sale of a business, whether it's the acquisition of one, whether you're thinking more about income streams than you're thinking about asset or appreciation buildup. And then there are those who are wanting to create a plan that they can enforce in their absence or in their disability. So what we talk about today and what we've talked about in previous episodes, at least over the last 4 to 8 weeks or so, are related to this very topic. And unless we get past this, we can't legitimately or fairly focus on a lot of the other things that we've talked about already in this show and that we'll go to in the future. But we will come back to these concepts. Now, last week we talked about gifts. Gifts play a huge role when you're talking about estate planning. Big picture pullback here. Now, you know, whenever you're looking at, gee, do I want my assets at the date of my death to be in my name, or do I want to have transferred them to someone else? And that's a difficult call sometimes. We've talked about the advantage of a stepped-up basis where you have capital assets that might have hundreds of thousands of dollars of appreciation that you would otherwise pay taxes on, but by leaving them in your estate, then they'll transfer and get that stepped-up basis to your beneficiaries. That's huge. I mean, there can be hundreds of thousands of dollars involved there. Then, of course, you have to weigh the possibility that that's going to go away. There's been discussion in Congress, there's been discussion at the presidential candidate level about whether capital gains or the stepped-up basis should remain. And certainly if capital gains go away, or if they're dramatically reduced in terms of the advantage we have right now of a 15% capital gains rate, if that changes, then they're probably going to tamper with what exists with respect to estate planning. We don't know that. It's speculation. But there is uncertainty. So you got to think about it when you're wondering early on in the game, you know, what will my end game be? Now, a lot of people decide, quite frankly, that they want to make transfers early on. They've decided that they think that this asset will appreciate a lot and they can go ahead and make the transition at the early stages. It allows for a lot of uncertainty. If they die sooner than later, then they at least have gone ahead and got into someone else's name, whatever that appreciation might have been since the date of transfer. Meanwhile, it allows you to, at the same time, perhaps retain some element of income in some limited degree of control, as we've talked about. You know, it's very common to use irrevocable trust to transfer these assets out of your name and for the benefit of someone else. The IRS, we know, scrutinizes those. So to the extent that you seek to control that through the ability to change provisions or the instructions in the trust terms, to the extent that you decide to change trustees, to the extent that you want to adjust the beneficiaries or manipulate those in some way, I can tell you that those are red flags to the IRS. So when you do these transactions, you got to plan on some loss, some substantial loss of control over those assets. That's not the same thing as saying that you can't have some degree of income coming back. I know that that's the dilemma that faces many people when it comes to estate planning is, how do I give and yet keep the income that I'm going to need to meet my financial needs? That is probably the classic problem that hovers over estate planning when you're thinking decades in advance of when you think that your death is statistically likely to occur. So how do you grapple with that? Well, one way is what we're going to talk about today. The traditional gift scenario simply doesn't deal with that problem. To the extent that you have an estate in which there are perhaps many millions involved, or at least let's say a sum that's dramatically in excess of what you're likely to use, then of course you can make decisions as to those portions that you know you will never need as a practical matter during your lifetime. And some of you I'm talking to perhaps fall in that category, and for many of these people, gifting is very attractive. But at the same time, there are circumstances, though, in which even those people will consider a transaction other than simply the traditional gift. So with that in mind, let's talk about what those alternatives are to gifts. But first, let's look at the categories that we've covered, the possibilities when you're thinking about, gee, what do I do with these assets? Well, one, we've decided you can hang on to it. Right, you can hang on to it and enjoy, hopefully, that stepped-up basis at some point down the road when you die. Another option is gifting. We talked about that last time. We'll interweave that to some extent in this discussion we're going to have today. And then another piece that I want to segment away from gifting, and I want to call it donating or donations. Donations means gifts to charitable institutions, charitable giving. That's treated from a tax standpoint very differently from a gift to a loved one. When you're making a gift to what would be called a 501c3 organization for which you're entitled to get a full tax deduction, or even some private foundations and other foundations, you can take deductions, but of course they're more restricted as a percentage of your adjusted gross income, etc. So naturally you prefer to get that 100% benefit that you can very often easily have by making the donation to a 501c3 charitable organization. That's the vast majority of organizations, incidentally, that you give to. It's the churches, it's the colleges, it's the medical institutions, things such as that. So those gifts are very attractive because they allow your dollars to do a sort of double benefit. Whenever you're making gifting to those organizations during your lifetime, far from looking at a gift tax, you're getting a deduction for the money that you transfer to these organizations. So it's actually reducing your current income. It's the inverse of if you had taken that money and given it to a relative, depending on the amount of the money and your exemptions and all that. So donations we'll talk a little bit about separately. And then finally there's the discussions of sales. Sales can come in a variety of different forms. You can sell something in the form of an annuity. That means that you have a private annuity. We'll talk more about that in a minute. Another is an installment sale, which the installment sale can come into actually two versions. When you do an installment sale, it can be a regular sale. We'll talk about that in a few minutes. Then we'll talk about what's called an SCIN, a SCIN, which is a self-canceling installment note. I know this sounds very esoteric to you. Bear with me. It's really not that esoteric. And remember, we're not teaching you to master the details of estate planning. What we're teaching you are the fundamentals so that you get the concepts. If you get the concepts, then you can communicate effectively with your lawyer. Keep your goals realistic here. You don't need to know the details of what we're discussing today. You just got to get the concepts for you to play your role most effectively as the client. So there's a self-canceling installment note, which is one of the two types of installment sales. And then finally, there's a category that can come in a variety of ways, but it relates to a sort of sale and leaseback or a gift and a leaseback. What it is a split interest transaction in which you sort of retain the right to enjoy the property that you have, that possession and enjoyment objective, and at the same time you're transferring some piece of it, and that you're presumably taking a deduction depending on the party to whom it's being transferred to, or you may be paying a gift tax, you may not, depending on the valuation of that interest that you transfer. All right, so let me go over those again. It's kind of a confusing list. There's gifts we talked about. Then we're talking about something that's similar to a gift, but we're calling it a donation, and that's when you give things to 501c3s and other organizations that you can take a deduction on.